So hi everyone, welcome to today's video. So Nifty 50 has crashed quite a lot, almost 5% in the last few days. So in this video, we'll be discussing about few points. First, we'll be discussing about if the Indian markets were overvalued, because of which this correction has happened. Second, we'll be discussing about what were the main reasons behind the crash. And in the end, we'll be discussing about what we should be doing with our investments and what can be the future of the Indian markets. So first, let's understand about the valuation of the markets. So for this, if we look at the Warren Buffett indicators, which is the ratio of total market cap versus the GDP, we can see that. So we can see the ratio of India's ratio of total market cap versus GDP. This is the green line. So in 2007 it was the highest. This was the time of the financial crisis, and again in 2021 it was around 100. So if this ratio is over 100, it is considered to be overvalued. But so right now, if we see the green line, it is 112 for the Indian markets. So according to this indicator, markets were a bit overvalued and the markets were due for a correction. Now, if we look at the different factors which has led to the market crash, so the first main factor is the Israel-Iran war which is happening. Now, how this Israel-Iran war is impacting Indian stock market is the main point is the import, export, and the commodities like oil. Now, these are the things which are the most impacted because of the war. Now, if we look at the oil prices, we can see that in the last Wednesday, the oil prices had climbed to more than 3%, which is quite significant. Now, all these trade and export impacts, the oil prices going up also creates an negative sentiment among the investors. This is one of the factors why the markets have crashed. Okay, so now coming to the second factor, which is the quantitative easing policies that has been introduced by China. We can see that the Chinese index has gone down significantly up, which is more than 20%. So this is the SSC composite index. This is the Hang Seng index of the Hong Kong, and this is CSI 1000 index, and it has gone up by 27% in the last 5 days. Now, this boom in the Chinese stock market is because of the quantitative easing policies that has been introduced. So, what is quantitative easing? So, if you look at the Investopedia, the formal definition for this is when the central bank purchases securities in open markets to reduce interest rates and increase the money supply. So, what China has done is it has instituted more than 100 million bond purchase program, which is going to increase the liquidity. And the second policy what China have done is about which I have discussed about in my community section is that China has introduced one mortgage refinancing policy. Okay, so under this policy, homeowners can negotiate with their lenders to finance their mortgages at prevailing market rates when there's a significant difference from their current rates. Also, the major banks of China are already preparing to reduce rates for the existing mortgages holders by the end of October. So, because of these two major policies, what China have done is it has created more liquidity in the markets. Because of this liquidity, more people are going to invest in the stock markets, real estates, and other forms of investments, and because of which we are able to see this kind of growth in the stock market. Moreover, what China have done is because of this quantitative easing policy to strengthen its economy, China has invested in two main things. One is the foreign exchange reserves and the physical gold. So if we look at these charts, we'll see that the Chinese foreign exchange reserves has grown significantly from June to August. And similarly, for the China's gold reserves, we can see that from 2022 to 2024, there is a significant difference. And China is aggressively investing in, in its gold reserves and the forex reserves to strengthen its balance sheet. Now, because of this, foreign institutional investors are investing in China. and the impact can be seen in the Indian stock market as well. So if we look at the data, we'll see that the foreign institutional investors have pulled out around 32,000 crores from the Indian market. So these were the two main points why we have seen a significant collapse in the Indian markets. So the first is the Israel-Iran war, which is impacting the trade and export and the oil prices. And second is the Chinese quantitative easing policy and strengthening its economy factors, because of which the foreign institutional investors are investing in China. Now let's have a look what we can expect from the Indian market. Generally, Indian stock markets follow a particular trend, as we can see in this chart. Okay, so here we can see that the markets will be mostly following this particular trend, and according to this, what we will see that from the high of 26,300 or something, we can see that the markets can go all the way down to around 24,400, which is a correction of around 7%. So this is the this is the correction that we can anticipate now. Now this is not for sure going to happen, but the prediction is, according to me, that the markets, that we can see a downfall of around 7 to 8% from its peak of 26,300. Okay, so that's it for today's video. See you in the next one.